Hi, this video is going to talk about the opportunity of investing in notes, a great way to have passive income backed by real estate. First, a little bit about me. I'm Beth Hale and I live in Denver, Colorado. I've been investing in real estate since 2004. I'm the founder and CEO of United Capital, and my company buys and sells and invests in notes. I'm lucky enough to be associated with underwriters and professionals in this business who between us have over 95 years experience in the business. I provide income streams for investors backed by real estate through my company. What if you could get your money working for you? We're all familiar with traditional investments. There's the stock market. And trying to find a mutual fund that returns a return you like after fees can be a bit of a search. And we've all either seen or experienced this. Banks have certificates of deposit. As of November, Wells Fargo's CD was returning 1.5% a year, which means that if you invested $100,000 in a CD there, you'd make $4.11 a day. Now, how much is your latte at Starbucks costing? Maybe $4.35 a day? So every day that you have that latte at Starbucks, you're wiping out the entire earnings that your $100,000 is making in that certificate of deposit. So now you know why banks offer you free coffee, but it's really not the same, is it? That's why we like investments backed by the security and high returns of real estate. Fad investments come and go, but everybody needs a place to live. Now, we're all familiar with this model. Harry, the homeowner, wants to buy a house, but he doesn't have the money for the entire purchase price of the house, so he borrows the money from the bank. He signs a promissory note and deed of trust guaranteeing the loan with the house as collateral. He gets the deed to the house at closing after he's signed all the paperwork with the bank and makes monthly payments to the bank. This real estate loan and the paperwork that supports it are collectively called a note. When we talk about a note, we're talking about the promissory note and the deed of trust or mortgage that secures the promissory note by the property. Now, this is a good deal for everybody. It's a good deal for the seller of the house because he gets to sell his house now. It's a good deal for Harry homeowner because he gets to buy the house and move into it right away. And it's a good deal for the bank, a really good deal for the bank. Why is that? We all know the answer to this. Because the bank not only gets a little bit of its principal back every month through the borrower payment, reducing its risk, it also gets interest or profit for the bank. But not only that, if Harry quits making the payments, the bank or lender forecloses on the property and takes back the title and the keys to the house from the borrower, in this case, Harry homeowner, who's a homeowner no longer. Once the bank forecloses on the property, the bank owns the property. What if instead of the bank making a loan to Harry so he can buy the house, the seller of the house decides to sell the house on seller financing? Harry signs a promissory note with the seller instead of the bank, gets title to the property, and makes payments directly to the seller. There's really no difference here between the seller and the bank. The seller gets a promissory note backed by a mortgage or deed of trust, and the payments from Harry are as secure for the seller as they were for the bank. What if you could be the bank? Then you could get the promissory note from the borrower that's backed by the real estate, and you could receive the payments every month, and you could receive the interest in the form of profit, and you could have all that security. Banks don't really sell notes to individuals like you and I, but individuals like the seller in our previous example sometimes sell notes, and other institutions sell notes. And if they make sense, companies like mine buy those notes. So let's take a look at an example of how a note might get created and then later sold. Let's say you had a house that was worth $85,000 and a borrower that wanted to buy that house and was willing to put down a down payment of $5,000. So he's got that much equity in the home. The mortgage note is going to be for $80,000. And let's say that mortgage note was written at 6.5% for a term of 20 years or 240 payments. And then the payment would be $596.46. The loan to value in this example, in other words, the $80,000 loan divided by the $85,000 value of the house, is 94%. And the investment to value, because the lender has that much invested, is the same. Again, we have a first lien note secured by the property. And this is what it looks like from the lender's point of view. He had his original outlay of $80,000. He gets a payment every month, no matter what the stock market is doing, no matter what the Fed is doing, no matter if the market tanks, no matter what's going on, he still gets his payment every month. And if he doesn't get his payment every month, we already talked about that. Over the course of this loan, the lender will make $143,000 on his outlay of $80,000. So now you know why being the bank is so profitable. Now, rarely do loans ever carry out the full term. They usually will cash out early in the form of a refinance or of the borrower selling the house, which is good for the lender in that case because the lender gets his money back sooner and is able to redeploy it. The lender then makes a 6.5% yield on this loan, which is the same interest that the borrower was paying. Now, here's a chart of the amortization schedule. The vertical part is the loan, and this curve represents the principal amount at any given time over the term of the loan. We've all seen something like this before, and we all know that principal gets paid off slower in the front of the loan than it does in the back part of the loan. So with that in mind, which do you think is the more valuable part of the loan, the first 5 years or the last 5 years? The answer is the first 5 years because more interest is paid during the first 5 years of the loan. So let's take a look at the same loan after 32 months have gone by and 32 payments. So we still had the equity from the borrower's original down payment of $5,000, but now his equity has increased even more because he's made 32 payments. Now the loan's been paid down to $74,317, and there's 208 remaining payments on the loan. The payments haven't changed, but the loan to value has gone down because now the loan amount is $74,000 and change. And the investment to value, again, what the lender has invested into this note, has also gone down. Notes like this are often sold at a discount. So here's the amortization chart after 32 months with the principal balance having gone down a little bit already. Now, what happens if this loan pays off early? Let's say it pays off after 5 years. Well, in that case, the borrower owes the amount of principal after 5 more years, which is $60,613. Again, it's a good thing for the lender because he gets all his money back, increasing his yield, and he gets his money back to redeploy into another loan. Let's say this lender decided to sell this note to an investor at a discount. Now, the unpaid balance is currently $74,000, and maybe an investor might come along and pay $69,250, let's say. Now, that would drop the investment to value for the investor from 87% down to 81%. And the investor's yield is going to go up to 7.5% because he bought the note at a discount. Now, the investor has purchased the note, essentially a payment stream, from the original lender. The unpaid balance at the time he purchased it is $74,000 and change, but that investor bought that at a discount for $69,250. He's going to get 208 payments from the borrower for a total of $121,000. The yield the original investor got, the yield the original lender got was 6.5%, but this investor's yield is 7.5% because he bought it at a discount. Now, you don't have to be an expert on interest rates and yields to be a successful note investor. The important part of this example is on his $69,000 outlay, the investor made $121,000, received back in total $121,000 after about 17 years. But what happens if this note pays off early? Now, here's the two amortization charts. The only parties still involved in this are the borrower and the investor that bought the note from the original lender. This curve back here with the dark blue represents the borrower's amortization schedule. The light blue one represents the investor's amortization schedule. So what happens if the loan pays off after 5 years? The borrower owes the same amount he did in the previous example, $60,613, because that's his amortization schedule. Things didn't change for the borrower. The nice thing here is that the investor doesn't get paid the principal he's owed here, but gets paid here, a difference of about $3,000. What if you only bought the first part of the payment stream and didn't have to wait until the note paid off in full? So let's talk about this. Buying just the first part of a payment stream. What does that look like? In this example, we're going to start with the original note with all 240 payments left on the loan. Let's say you buy just the first 8 years or 96 payments of this loan. It's called a partial, and it's the front end of a loan no matter how many payments you bought. Could be 3 months, could be 15 years. The original note holder, and in this case the seller, holds the last 144 payments of the loan. Let's say you pay $42,961 for the first 8 years, or 96 payments. As a front-end investor, you are not on your own. You are in partnership with the original note holder, who holds the remaining payments and is very motivated to see the loan perform, since he wants to get his payments. This is great for people who are new to note investing. After the 96 months are up, you have collected $57,260. So you made over $14,000 in 8 years, for a yield of 7.5%. It's great for you, the partial investor, because you don't have your money tied up for the entire term of the loan, and you don't have to deploy so much capital because you're buying part of the loan and not the full loan. Also, there's less risk involved because you have a much lower loan-to-value ratio. The value, of course, being the value of the house. Remember, the house in this case is worth $85,000, so your loan-to-value ratio is less than 50%. Here's a graphical representation of what you're buying. The gold section is the original note and the payment schedule for the borrower. Remember, no matter what part of the note is sold, it doesn't change the conditions of the loan for the borrower. The blue section represents what you, the partial buyer, bought. You paid $42,961 and your term goes out 96 months. What if the note pays off early? What happens to your investment? In this example, the borrower pays off the note after another 60 months. The balance on the note is $68,471, and the unpaid balance of the partial down here is $19,175. The $19,175 goes to you, the partial investor, and you collected $35,788 in payments already, for a total of $54,963. If you remember, you paid $42,961 for the partial, so in 5 years you made around $12,000 as a passive investor. It's good for you because you got your original outlay back faster and you can redeploy it. The difference between what you are owed and what the borrower owes goes to the owner of the back end of the note. Remember, you only bought part of the note, so you're only due your part when the note pays off early. Now, you might be thinking, what about managing the notes and the payment streams? Well, we use a note servicer, and basically they do all the work. They collect the payments, they escrow the taxes and the insurance, they make sure we're licensed and compliant, and they communicate with the borrower. So the payment goes from the borrower to the servicer, and the servicer to you. It's pretty passive for you, the note owner, because we're outsourcing everything to the note servicer. Note investing has many advantages. High yield, generally better than CDs or annuities are paying. Predictable yields, they don't change over time. Liquid, you can sell all of your note, you can sell part of your note, you can even borrow against a note with a collateral assignment. You can tailor the investment to you by buying just a small stream of payments, and you're providing financing for a home for somebody to live in. And let's not forget, secured by real estate. Another cool thing about note investing is that they're excellent vehicles to grow your tax-deferred or tax-free accounts, especially if you only have a little money in them, because you can buy a partial for just a few $1,000s. If you have further questions or want to talk about notes, please reach out to me and I'd love to talk to you about them. Thank you for listening to my video about the opportunities provided by note investing.